the Minda Q4FY25 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sunil Bora, Group Chief Financial Officer, for his opening remarks. Thank you, and over to you, sir.
Thanks, Elvis. Good afternoon, everyone, and a warm welcome to all the participants. On the earnings call today, I am joined by my colleague, Ankur Modi. We have uploaded our financial results and investor presentation for Q4 and FY25 on the stock exchanges and our company's website. I would like to begin by giving some insights on the economy, followed by the current scenario in the auto industry and our financial and operational performance for Q4 and FY25. Post that, we will open the floor for Q&A. The global economy exhibited resilient growth of 3.2% in 2024, despite a backdrop of persistent inflationary pressures, geopolitical tensions, and structural headwinds. While year started with positive note, expecting declining interest rates and maintaining the growth momentum, rising trade tensions, weak consumer sentiment, and geopolitical disruption resulted in projected growth at 2.8% for 2025. U.S. implemented broad-based tariffs in April, triggering retaliation and sharp volatility in trade and markets. While these measures have been paused for 90 days amid ongoing negotiations, we remain cautiously optimistic. Regionally, growth forecasts have been revised down across the board. U.S. is expected to grow at 1.8%, the Euro area at 0.8%, and China at 4%. Emerging markets are also slowing, though India remains a bright spot at projected growth of 6.2%. India continues to stand out as one of the fastest growing major economies globally, consistently outperforming both advanced and emerging market peers with a decent GDP numbers compared to other countries. This resilience is underpinned by strong structural fundamentals, including a young and expanding workforce, sustained momentum in structural reforms, and a vibrant services sector that remains key engine of growth. In this fluid landscape, agility, discipline, and clarity of purpose are critical. As a company, we remain focused on adapting swiftly to external changes, safeguarding resilience, and leveraging opportunities in structurally attractive markets. Moving on to the automotive industry, for the quarter ending March 25, the Indian automobile industry recorded a year-on-year production volume growth of approximately 6%, with total production reaching around 78 lakh units. For the full fiscal year, the industry posted a 9% growth. This performance was primarily driven by strong demand in the two-wheeler and PV segments, supported by a combination of factors, including increased infrastructure investment, supporting government policies, and a sustained push towards sustainable mobility. Sound economic fundamentals and positive market sentiment further contributed to the industry's continued momentum. However, growth across segments was not uniform. The CV segment saw a decline of 3.6% for the year, reflecting the impact of subdued industrial activity and delayed government spending. While the overall industry remained resilient, performance in certain pockets suggests that underlying demand recovery is still stabilizing. Nonetheless, sound economic fundamentals and a generally positive market environment helped sustain the sector's forward trajectory. In Q4 FY25, PV production grew by 5% year-on-year, reaching to 14.11 lakh units. This was primarily driven by strong demand in the utility vehicle segment. Q4 FY25 showed continued growth, albeit at a moderated pace compared to the high growth rates of the preceding quarters. This moderation is attributed to the high base effect, where growth appears less dramatic when compared to an exceptionally strong prior period. For the full fiscal year, PV production rose by 3% to 50.6 lakh units, again led by a robust growth in the utility vehicles. The overall market continues to shift in favor of SUVs and premium offerings, which comprise of 62% of overall PV production. Looking ahead, the segment is poised for growth, supported by new product launches and rising consumer interest in premium categories. However, headwinds persist, including global economic uncertainty, trade-related tariff pressures and their dampening effect on disposable income. Demand of entry-level car remains. Overall, FY26 is likely to close with low single-digit growth. Two-wheeler segment delivered year-on-year growth of approximately 6% in Q4 FY25, with production reaching around 58 lakh units. For the full fiscal year, the segment posted a robust 11% year-on-year growth, with total production reaching approximately 2.39 crore units. Growth was largely supported by strong rural sentiment. Exports also contributed meaningfully, rising 20% year-on-year, driven by 28% increase in motorcycle exports and an exceptional 194% surge in mopeds. The three-wheeler segment recorded a steady 10% growth, primarily driven by continued demand for passenger carriers. In Q4 FY25, the CV segment registered a growth of 3%, with the total production reaching approximately 2.9 lakh units. While domestic demand remained relatively muted, with a modest increase of around 1.5% year-on-year, CV export provided strong boost, surging by nearly 56%. India's electric two-wheeler EV market experienced a notable 9% quarter-on-quarter decline in sales to 3.05 lakh units from 3.33 lakhs, despite achieving a significant year-on-year growth. While the fiscal year concluded with over 1.14 million e-two-wheelers sold, a 21% increase from FY24, the momentum slowed down in the final quarter. The reduction in government subsidies, charging infrastructure challenges, and range anxiety are some of the challenges impacting the segment. Despite near-term challenges, long-term prospect for e-two-wheeler remains highly promising, with various government initiatives like PM Drive Scheme, state EV policies, technology advancement, increasing charging network, as well as the battery range. Coming to financial and operational performance, you can refer to slide 7 and 8. Minda delivered a robust financial performance in Q4 FY25, marked by strong top-line growth. Consolidated revenue from operations for the quarter stood at 4,528 crores, reflecting 19% year-on-year growth from 3,794 crores in Q4 FY24. This growth was driven by broad-based strength across multiple product segments, particularly switches, alloy wheels, and seating systems. Additionally, the consolidation of Minda Westport and Minda Onkyo during the year contributed to the revenue uptick. EBITDA for the quarter reached a record 527 crores, registering 11% year-on-year growth from 474 crores. EBITDA margin moderated to 11.6% compared to the corresponding quarter last year. This is primarily attributable to higher accumulated price settlement in Q4 last year. Furthermore, the commissioning of 3 new projects over last 6 months, currently in the ramp-up phase, led to higher costs. Employees' costs also increased during the quarter, primarily due to additional manpower at our operations, new projects, new Czech Republic R&D center, and higher gratuity provision. We would like to inform that based on the increased utilization, better cycle times, etc., and considering the short life of tools in casting business, we plan to change our accounting policy as we move into the new fiscal year. These tools, which were capitalized, however, considering the useful life of these tools, these will now be charged off the income statement. Estimated impact of the same is likely to be around 40 crores on an annual basis, though a similar amount shall be reduced in depreciation over a couple of years. Finance costs increased to 41 crores compared to same period last year, largely on account of higher borrowings to support capital expenditure and working capital needs. Depreciation expenses also rose in line with capitalization of new projects. Share of profit loss from associates and JVs stood at 55 crores for Q4 compared to 58 in the last quarter, FY24. While ventures such as Denso10, Roki, TRM, and TG continue to perform well, the transition of Minda Westport and Minda Onkyo into fully consolidated subsidiaries resulted in the financials being accounted on line-by-line basis, hence reducing the share of profits reported under this head by 5 crores. Profit after tax attributable to Minda for the quarter was 266 crores compared to 284 crores in Q4 FY24. However, it is important to note that previous year's figure included a one-time gain of approximately 20 crores from reversal of provision for interest on CUD related to EPCG, following a favorable Supreme Court ruling. Adjusting for this, the normalized PAT for Q4 was 265 crores. Q4 FY24 was 265 crores. Sorry for that. Full year FY25 financial overview, you can refer to slide number 9, please. For the full year ended March 25, consolidated revenues were 16,775 crore, achieving a 20% year-on-year growth. This significantly outpaced the broader auto industry volume growth of 9% for the same period, transitioning into over 2x industry volume growth against the company's long-term guidance of 1.5x. EBITDA for the year grew by 18% to 1878 crore with an EBITDA margin of 11.2% in line with our guidance. Profit after tax attributable to Minda stood at 943 crore, up 8% from 875 in FY24. As mentioned above, the growth in PAT excluding exceptional income is around 9%. This growth underscores the company's ability to scale operations effectively, maintain profitability, and deliver consistent shareholder value amid ongoing industry transformation and increased investments in future-ready technologies. Moving to business segment-wise performance, starting with switches, you can refer to slide number 12, please. Switching systems segment continued to demonstrate exceptional performance in Q4FY25, contributing significantly to overall revenue mix. The segment recorded revenues of rupees 1,144 crore during the quarter, accounting for a substantial 25% of company's consolidated revenues, highlighting its critical role in a diversified product portfolio. For the full fiscal year FY25, the switching system business achieved revenue of 4,204 crore, representing a robust 15% year-on-year growth compared to 3,663 crore in FY24. This performance underscores our strong market position and our ability to innovate in a segment that is evolving rapidly with changing automotive trends. The growth in this segment was driven by multiple factors. Firstly, the increasing trend of premiumization across both two-wheeler and passenger vehicle segments, which has led to rise in kit value per vehicle. Second, exports played a pivotal role in driving growth, particularly in the two-wheeler switch category. Our international business saw strong traction during the year, reflecting our competitive cost structures, high quality standards, and deep customer relationships with global OEMs. Moving to lighting systems, the business continues to be a cornerstone of Minda's growth story. Delivering another strong performance in Q4 FY25, the segment generated revenues of rupees 1,018 crore during the quarter, contributing a substantial 22% to company's consolidated revenue. For the full year, lighting business recorded revenues of 3,863 crore, registering a healthy 15% year-on-year growth, driven by technological leadership and increased content per vehicle. Our strong show in both two-wheeler and four-wheeler lighting segment is a testament to Minda's ability to stay ahead of industry trends through innovation. In the two-wheeler segment, we have reinforced our leadership by becoming a major supplier of advanced lighting solutions for electric two-wheelers to leading OEMs. In light of the significant growth witnessed in the two-wheeler lighting segment over the past few years, our existing facilities at Sonipat and Bahadurgarh are now operating at full capacities, leaving little room for further expansion. To address this and support future growth, we plan to consolidate the 3 plants at these 2 locations into a new, larger facility to be built at Kharkhoda, Haryana. This strategic move will not only increase our manufacturing capacity, but also provide space for future expansion. The total estimated capital expenditure for this relocation and expansion, excluding land, is rupees 233 crores. In the four-wheeler segment, our technological progress is gaining global recognition. A notable milestone during the year was securing a prestigious order for the supply of advanced lighting systems for an autonomous robo-taxi being developed by a leading American technology company. This order not only affirms our capabilities in high-end lighting solutions, but also marks our entry into next-generation mobility platforms. To further advance our technological edge, we have established R&D Center in the Czech Republic. This global innovation hub will focus on development of next-generation automotive lighting technologies, including adaptive lighting, LED matrix systems, and integrated electronics. Looking ahead, we expect the positive momentum in lighting business to continue, supported by the scaling up of operations at our new plant in Khed City and the ramp-up of production for recently acquired orders. Moving to casting business, the business also delivered a robust performance in Q4 FY25, generating revenue of 860 crore, accounting for 19% of group consolidated revenues. Of this, four-wheeler contributed around 471 crore, two-wheeler alloy wheel at 247 crore, and the aluminum die casting segment at 142 crore. For the full year, the casting business recorded revenues of 3,220 crore, reflecting a solid 14% year-on-year growth. Of this, four-wheel alloy wheels contributed 709 crore, two-wheeler alloy wheels 932, and the aluminum die casting segment 574 crore. Both two-wheeler and four-wheeler alloy segments benefited from strong demand and the recent capacity expansions. We commenced production from additional 30,000 unit monthly line for four-wheel alloy wheel at our Bawal, Haryana plant, bringing the total installed capacity to 420,000 wheels per month. Construction of our greenfield facility is also progressing well at Kharkhoda, with the first phase of 60,000 wheels per month expected to be commissioned by Q4FY25. On the two-wheeler front, we have commenced commercial production at our expanded Supa, Maharashtra facility. This expansion adds 2 million units of capacity, raising Supa total to 8 million units annually. Additionally, we have announced 200 crore investment in the new two-wheel alloy wheel facility at Bawal, with a planned annual capacity of 1.5 million units. This facility is targeted for commissioning in Q2 FY27. Once the Bawal plant is operational, our total two-wheel alloy wheel capacity will reach 9.5 million units annually, further solidifying our market leadership and supporting the Make in India vision. Moving to seating system business, you can refer to slide number 13. The business continued to contribute meaningfully to overall performance, generating revenues of 325 crore in Q4 FY25, accounting for 7% of consolidated revenues. For the full year, the segment reported revenue of 1155 crore, which is the highest ever. Growth during the year was driven primarily by commencement of supplies of pneumatic suspended seats to a leading domestic OEM and increased demand for bus passenger seats. Notably, this growth was achieved despite a decline in export, which was impacted by a downturn in the European market, particularly affecting one of our key customers. Looking ahead, we expect the seating business to sustain its growth trajectory, supported by recently confirmed orders and upcoming execution of these programs. Moving to acoustic business, the segment reported revenue of 189 crore in Q4, maintaining a 74% contribution to consolidated revenues. For the full year, the segment reported revenues of 763 crore, reflecting 8% year-on-year decline. The domestic business grew by 7%, driven by sustained OEM demand. However, overall performance was impacted by persistent headwinds in the European automotive market, as our European subsidiary Clarton Horn declined by 14% year-on-year basis. Moving to other products, where we have a lot of sunrise businesses. The other product business delivered strong performance, generating 992 crore in revenue during Q4 FY25, contributing 22% to the consolidated top line. Within this, the controller business contributed to around 157 crores, sensors and ADAS 211 crore, blow molding products at 127 crore, Minda JV at 98 crore, and the alternate fuel business at 143 crore. The remaining revenue was driven by aftermarket trading, external sales from Minda Catalyst, engineering services in Europe, and battery sales in the aftermarket channel. For the full year, revenue from this segment grew by 60% to 3,571 crore, reflecting our strategic focus on emerging technologies and new mobility solutions. Our EV system vertical under Minda JV achieved revenues of 382 crore in just its second year of operations. Meanwhile, the sensor and ADAS business scaled to 804 crore, and our alternate fuel business through JV Transport grew to 501 crore, further validating our commitment to future-ready sustainable mobility solutions. Moving to the EV segment, you can refer to slide number 16 and 17. We are pleased to note our success in positioning the company at the top of league in terms of the product offering for e-two-wheeler components. In line with our strategy to deepen our presence in the EV space, as you know, the company is in process of acquiring the remaining 49.9% stake in its joint venture with Q4, along with associated e-drive technologies. This acquisition, valued at approximately 195 crores, is expected to be completed by end of Q1 FY26 as originally envisaged, enabling full integration and unlocking greater synergies in EV component manufacturing and open access to the global markets. As per our stated strategy, we have also been working on strengthening our EV product portfolio for four-wheeler EV segment. Towards that objective, we had entered into JV with Suzhou Inovance Automotive to manufacture high-voltage EV components covering charging control systems, inverters, motors, e-axles. To support the growth of this venture, board had approved 423 crore investment in a dedicated facility for high-voltage EV powertrain components. Capital expenditure will be phased over next 2 to 3 years, with phase 1 expected to be commissioned by Q4FY25. The project will be executed through a new joint venture company, Minda Auto Innovation Private Limited, with Minda initially holding 100% equity. Upon receiving the regulatory approvals, Innova's Automotive Fluids Hong Kong subsidiary will acquire a 30% stake. We have already secured an anchor order for e-axle, which will be manufactured at this upcoming facility. Moving to our aftermarket international revenue, we can refer to slide number 14 and 15. For the quarter ended March 25, the OEM segment continued to be the dominant contributor, accounting for 94% of our total revenues, while the aftermarket business contributed approximately 6%. Our aftermarket division reported revenues of 279 crore during the quarter. International sales currently represent around 10% of our total revenues, reflecting a steady upward trend. While the international market remains a key pillar of our long-term growth strategy, our domestic business continues to deliver more pronounced growth. We would like to clarify that the ongoing U.S. tariff situation has no material impact on our operations, as exports to U.S. constitute less than 2% of our total revenues. In fact, we have witnessed growing demand in the U.S. for our two-wheeler products, reinforcing our competitiveness in global markets. Moving to kit value, which is normally our annual slide. As you would see, we have witnessed increase in potential kit value across all vehicle categories and segments for FY25. Increase in kit value for four-wheeler can primarily be attributed to addition of sunroof, advanced lighting solutions, smarter ADAS and sensor solutions, and premium alloy wheels. Increase in kit value for two-wheeler can be attributed to advanced lamps, smarter switches, and higher realization for alloy wheel led by commodity price. Moving to our cash flow and debt levels, our net debt as of 31st March was at 2,091 crore compared to 1,318 crore as on March 31, 2024. The net debt has increased on account of expansion capex as well as expenditure for land bank primarily at Kharkhoda and small adjacent plots of land at Bhawan and Chennai, totaling to around 394 crores and increased working capital requirement. The total capex, excluding the land bank for the full year, was around 250 crores, while sustaining and growth capex has been financed from business cash flows. The capital expenditure, primarily land bank and increase in working capital requirement, has resulted in incremental debt. Our net debt to equity as at 31st March 25 stood healthy at 0.34%. Moving to ROCE and ROE, we have achieved ROCE of around 19%. This is profit of FY25. Kindly note that the capital employed considered for calculation does include the capex for land bank as well as CWIP, which is currently not generating returns. ROE for FY25 is around 18%. The board has also recommended final dividend of 1.5 rupees per share, which is 75% of face value for shareholders' approval. Total dividend along with interim dividend already paid becomes rupees 2.25 per share, which is 112.5% of the face value. We have been consistently increasing our dividend payout ratio from 10% in FY19 to 13.7% now. With double effect of increasing profits and increasing dividend payout ratio, our dividend payment amount has also increased 3 to 4x in last few years to propose dividend payment of around 129 crores for FY25. The above underscores our commitment to returning value to shareholders on a consistent basis. Moving to ESG, in line with the global best practices and in corporate governance, Minda has separated the roles of chairman and managing director. As you know, we had earlier announced the elevation of Mr. Mehra as managing director effective 1st April 25, whereas Mr. Minda has transitioned to an executive chairman role. With over 3 decades of rich experience and deep domain expertise, Mr. Mehra has been key architect of Minda's growth journey since 1995. In a proud milestone of its journey towards inclusive development, Minda Limited CSR arm has inaugurated its 18th Samarth Jyoti Center in Kagalahalli, Harohalli, Karnataka. This expansion marks a renewed commitment to fostering education, skill development, and community empowerment across India. What began in 2012 with the single center in Nagpur, Haryana has now evolved into a transformative movement. Each Samar Jyoti center serves as a vibrant hub of opportunity designed to uplift underprivileged communities through vocational training in tailoring, beauty culture and computer literacy, community schooling and remedial education for marginalized children, livelihood support and capacity building for women through self-help groups, preventive healthcare services for the undeserved. Guided by the belief that true empowerment must be both inclusive and accessible, the Samarth Jyoti initiative has grown to 18 centers across several states, positively impacting the lives of millions and inspiring hope, dignity, and self-reliance in every corner it reaches. As we look ahead, Minda remains well positioned for sustainable growth, backed by strong fundamentals, a diversified product portfolio, and ongoing investments in emerging technologies such as electric mobility, advanced electronics, and automotive lighting. Our consistent ability to outperform the industry, delivering more than 1.5x volume growth compared to market averages, underscores the strength of our customer partnerships, our focus on innovation, and commitment to operational excellence. We will continue to invest in expanding both our capacities and capabilities. In FY26, we plan to incur a total capital expenditure of approximately 1,300 crores, comprising around 500 crores in sustaining capex and around 800 crores in growth-oriented capex, which is based on the current approved projects. While we have built some strategic land bank in Kharkhoda and Khed, we are in the process of continuation of building the same in other key automotive hubs such as Chhatrapati Sambhajinagar, Tamil Nadu and Gujarat, for which we may spend around 250 crores in FY26. We have recently received the allotment letter for approximately 88 acres of land in Chhatrapati Sambhajinagar from Maharashtra government. These investments will be primarily funded through internal accruals. With strategic capacity expansions, a healthy order book, and an enhanced focus on innovation, localization, and value addition, we are confident in maintaining our growth momentum. Despite a lot of plants which are coming in operation next year and also in the phase of initial growth, we continue to our guidance for an annual EBITDA margin of 11% plus minus 50 basis points. While revenue growth will generate operating leverage, initial costs related to new plant startups and expansions may partially offset these benefits. Nonetheless, we are entering the next phase of our journey with confidence, agility, and a clear vision. We remain committed to creating long-term value for all stakeholders and are excited about the opportunities that lie ahead. With this, I would like to now open up the floor for questions.
Thank you, sir. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Chandramouli Muthiah from Goldman Sachs. Please go ahead.
Hi, good evening, and thank you for taking my questions. My first question is just related to the UK-India FTA as well as expected US-India bilateral agreements. So I think in your slide 4, you've mentioned that there could be additional opportunities for the local auto component industry from the UK-India FTA. So if you could just give us some color on what is the current level of exports from India to the UK for auto components and what is the current level of imports, just to understand the balance of auto component trade there as well as where you see opportunities from this particular arrangement.
Yeah. Anything else, Chandu?
Yeah. So second question is related to Minda Innovations Limited, the JV with Innovans. So you did mention that there is e-axle, which is the first order that you've got. So if you could just give us a rough idea of what the kit value is, when the SOP might happen there, and given that it's 70-30 equity arrangement, capex arrangement, is this going to be consolidated in our accounts or will it be share of profits from JV? That's the second question. And the last question is just around this quarter, we've had a lot of top line growth, but the EBITDA growth is 11%. So I think there's been a 90 bps YOY drag on EBITDA margin. You explained part of that could be because of settlements which are still due from OEMs and raw materials, but just trying to understand what part of that 90 bits drag in margin is due to the startup costs at some of these facilities that you've set up in the last couple of quarters. So those are 3 questions.
Okay. Thanks, Chandru. So in terms of the first question on UK India FTA and US India bilateral, so obviously US India bilateral discussion what happened, as I said, we remain cautiously optimistic. Hopefully something good will come out based on whatever we are listening or hearing out from the government and the other sources. In terms of the UK India FTA, we all know that there are multiple sectors wherein the path has been laid out by the government for next 10 years as to how the rates eventually will come down. So as of now, we don't have any significant exposure to UK, but in past we have been in touch with some of the customers. Hopefully, with this, some doors might open, but it's too early to comment on that in terms of opportunities. But our point was more in terms of the sector per se, because if the rates and all come down, it will be hopefully positive for the entire sector from the automotive components perspective. From the second question was the innovation JV, EXL value and SOP. So SOP, as we have mentioned, is in middle of next financial year. And in terms of value, it's very difficult to give value, Chandru, because while we do have value for per kit, obviously, which we can't share because price sensitive information, a lot is also depending off in terms of the volume optics, which this market is in terms of a phase where there are a lot of moving parts and it's a high growth segment. So as of now, while we do have some value indication from our customers, we would not like to speculate in terms of what the values are going to be in future. So the way we have done announced this capex is also that while we will construct this infrastructure in terms of land, building, utilities, etc., the plant and machinery we will do in a phased manner as we get the increase in the volume uptake. And whether it will be consolidated or line by line or a share of profit, was there a question on this? Yes, it will be consolidated line by line because it is going to be eventually 70-30 JV, majority being Minda Limited. So it will be consolidated line by line from Minda perspective. Then your next question was top line growth versus the EBITDA margin and the drop of 90 basis points compared to last year. As we said, last year, yes, there was some price increase, but in this quarter, in terms of the costs, which the startup cost you mentioned, which will be there sustainable, there is roughly around 20 crores of additional manpower cost which we have incurred during this quarter because of number of increase in people during the quarter. So that we believe obviously will be sort of a sustainable cost. Plus there are some other administrative expenses around similar numbers.
Got it. That's helpful. Thank you very much and all the best.
Thank you, Joseph.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Mumuksh Mandalesha from Anand Rathi Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity and congrats on the continuing strong performance, sir. So firstly, can you help us understand this provision of fundraise of 2,500 crore? Would it be a debt-driven or equity, sir?
Mm-hmm. Next.
Sir, can you just update what could be the order size for this four-wheeler EXL component and what could be the order size for the sunroof business and the charging business, sir? And thirdly, sir, the lighting revenue growth this quarter was lower. Also, we had the new plant in Pune last quarter just started. Any view for next few years based on the orders and the capacity? How do you see the growth and the market share in the lighting segment?
Mm-hmm. Sure.
And lastly,
thanks,
yeah, sure.
Please go ahead.
Please go ahead. Okay. So
No,
lastly,
please finish your question, please.
yeah, sure. Lastly, in the presentation, the two-wheeler EV specific capex has been changed. Just I want to understand what has changed this quarter, sir. The Bowler and the Minda EV system capex, sir.
Okay. So we'll get back to you on this last question, but moving from starting. So the approval of 2,500 crore is an enabling of approval. It is for both debt and equity. And as you would have seen, Mumuksh, we have been taking this approval every year. Even last year, we had approval of roughly around 2,000 crores. This is only an enabling approval. As of now, we don't see any clear visibility in terms of any long-term need of the funds, because based on the capex numbers what we have shared and the expected profitability, hopefully we should be able to internally fund all the funding requirements. In terms of order size for EXL, as I little while mentioned to a question from Mr. Kanimoli, it is very difficult to give the order size. While we do have a number, the biggest factor of that order is the volume, which obviously is only an estimated number. So as I said, we don't want to speculate what the volume is going to be, because it's at the end of it, it's a guidance and an assumption. So that's why we are not able to give you this order size. But I can tell you that the business which you have got is the state-of-the-art 6-in-1 EXL, which is the first in time that is going to be used in India, and we will be manufacturing that at our Khed City plant. In terms of sunroof, was another question. Sunroof revenues, I think we have shared in the past. Based on the expected volumes indication, the revenues initially was estimated to be around 160 crore, but that number has been revised upwards. So current visibility is that it will be roughly around 230 crores or 240 crores of annual peak revenue for sunroof. For charging business, same as I said, again there's EV part, so I would like to maybe be a little cautious in terms of giving numbers for anything related to EV as of now. Lighting revenue growth was lower, we said, and what is the next 3 years plan? So lighting revenue growth has consistently been actually very good. If you see, for last year also, we have moved from around 3,300 crore of revenue to 3,800 crore of revenue, which is almost like 15-20% kind of growth, which is a significant number considering the industry growth numbers, which is single digit. And as we move forward to next year, as you would have noticed that the board has approved today the setting up of the new two-wheeler lighting plant, which is primarily to cater to the increased volumes and the new businesses, which we are not able to now do from our existing plants, because all these 3 plants are facilities which are very old and running very close to the capacity. In fact, there's not much of scope beyond a year. And that's how maybe after a year and a half, we should be able to move to a new location. So we do remain very optimistic on the lighting growth. And in fact, this is a business where you know that the kit value also has been helping us to deliver this kind of outperformance in addition to the new technology, LED lamps, etc. So we do remain highly optimistic in terms of next 3 years, this business to continue to grow more than 1.5x of the industry growth, which has been in line with our guidance as well.
Got
I hope I answered what.
I just lastly just clarify, lighting should continue to grow in double-digit kind of a range. That's fair to say, right?
Very difficult to say, Mumuksh, single-digit, double-digit, because you know that the biggest factor is the industry volumes. Now, if the volumes remain very low, then it's going to be difficult, because that is not in our hands. So what we've been saying is, we'd say, for example, if industry grow by 5, 7, 8%, then definitely we'll be growing by a double-digit. But if industry grow much less than that, then it obviously will be a situation where we have to see how do we still below that kind of a number.
Got it, sir. Thank you so much for this.
Thanks so much.
The next question comes from the line of Siddharth Bera from Nomura Holdings. Please go ahead.
Yeah, hi guys. Thanks for the opportunity and congrats on a great set of numbers. The first question is on your sensors, controllers, and the Westport business. Since while they have ramped up quite well if you look at on a YOY basis. So some color there, how do you see the growth in the next 2 years in each of these three businesses? Where are the tailwinds which you are seeing, and how to think about growth in these three businesses? That is one. Second is on the alloy wheel side, if we see the growth what we are delivering now, is it more representative of the industry, or do you still see in some segments there is a sort of capacity constraint, and with more capacities coming up, you can still continue to grow faster? And here, aftermarket seems to be a very small part. While there is a lot of potential, we have not seen that sort of going up in your aftermarket mix. So what are the thoughts there? And so lastly, on the capex and investments, I have mentioned 1,300 crores. I believe there is another 200 crore you need to pay for the Freevo stake acquisition. So some color if you have accounted this here, or that will be separate. And for the Suzhou Innovance of 423 crores, how much have you accounted for in this number of 1,300 in FY26? That will be also.
Okay. Thanks, Siddhartha. Thanks for compliments. So in terms of first question on sensor, controller, and Westport. So sensor business, sensor and controller business, earlier we used to talk together, and we took a target of growing it from 100 crore to 400 crore. And if you see this year itself, our sensors and controller put together has done more than 1,100 crores. So this business continues to be outperforming our own expectations, led by a lot of innovations, new products, new technologies, etc. So the application of sensors has been increasing, and so are the controllers. And we are optimistic of continuing this growth momentum, at least in sensors. And also in Westport, we have been able to get a lot of new business in Westport, the CNG business. The government focus on improving the CNG infrastructure has actually helped the penetration. And you would have seen almost most of our customers are either have launched or in process of having our CNG vehicle. So that business is definitely very promising, and we do expect this business also to grow in terms of the outperformance, same 1.5 to 2x of the industry growth. We do expect this business also to deliver. In terms of alloy wheel growth, you said, is it more representative of the industry and its capacity constraint? I would split this into two because of this different dynamics, both four-wheeler and two-wheeler. So four-wheeler business year on year has grown almost 15% from 1,350 odd crore to 1,540 crore. Now, obviously, the base is also becoming bigger. And the another factor here is that the application ratio has not grown to the extent what we have assumed. While we do remain optimistic in terms of the application ratio to grow gradually to what the global levels are. But for last year, we are almost same as what the year before it was, maybe around between 42 to 44% kind of range, and there has been no significant increase in the application ratio, and that's why you are seeing this number. But despite that, we have actually grown much more than industry growth. Industry growth is 5%, but whereas we have grown by 15%. So it's definitely much more than industry growth. And its capacity constraint is a constraint in actually two-wheeler. So two-wheeler continues to run at full capacity. We have ramped up from 6 million to 8 million. It's operating at full capacity, and that's how we have seen announced capacity of another 1.5 million expansion. So this business continues to show promising signs of continued future growth. ESD seems small, and what are the thoughts? We have been honestly working very hard in terms of improving our aftermarket business, in terms of adding more dealers, more consumers. But we all know that this has been facing significant challenges, maybe the cheaper imports or focus from our customers also directly from the aftermarket segment, which is good for us also in a way, because whatever our customers also sell through their aftermarket channel is a sale also for us. But for us, we don't account that as an aftermarket sale. We account for that as a OE sale because it's at the same customer, same pricing, etc. So That is why we are not seeing a significant move in PSC or aftermarket. But we continue to work on that, and as we speak, we are actually number one in terms of the volumes in India, and number two in terms of the value in terms of our aftermarket revenues for last year. But to your point, yes, we do remain very committed on the medium to long-term growth of the PSC segment. In terms of FRIWO of investment of 195-200 crores, yes, it is separate. It is not part of 1,300 crores of the capex and sustaining our growth. It is not part of that.
That is, sir. So thanks. So one clarification: this 40 crore annual charge which you mentioned, this will be from next year, right? It has not come in the current quarter. Will that be the right assumption?
Correct.
Sure, sir. Thanks a lot, sir.
Thank you.
A reminder to all participants, you may press star and one to ask a question. The next question comes from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, good evening, and thank you for the opportunity. First question is on the JV on the four-wheeler e-axle. So while we are investing the entire amount now, and then the JV partner will be acquiring this 30% stake later on, if there is a delay in, say, government approvals, etc., for this 30% stake, would there be any kind of impact on the technology transfer or on the product development, etc.? That obviously we have a timeline here in mind. So how would that work, sir?
No, so as I said, Mukesh, so originally if you see, it was actually a PLA which we have entered into, and which we wanted to convert it to a JV to make sure that we work as real partners and not technology partners. So that the intent is very clear. And when we have gone today ahead with the JV, I can tell you that while in India we need approval, in China also they need approval, and they have also formally filed. They have also filed for approval in China, and they are also very optimistic that they will get the approval, and so are we. But this is a process which we have to undergo. So in terms of commitment or in terms of product, there is nothing, no concern as of. And the business what we have secured, they are actually working very parallelly. In fact, we recently had groundbreaking ceremony also where their team was here, and they are fully committed, and we don't feel that any delay because of the government approval will delay our production or something like that.
Got it. And secondly, on the two-wheeler EV business, while we have been kind of clocking, a run rate there on two-wheeler EVs, is what I probably understand is that a lot of that business is still DC-DC converters and chargers, etc. But have we seen any major breakthrough with respect to traction motors, motor controllers, those kind of components for the two-wheeler EV business?
Yeah, Mukesh, you are right. So while initially it was more of DC-DC converters and chargers, yes, we have got a breakthrough in motor controllers, which we will be manufacturing in the coming financial year. We have already received the order. It will be in SOP in the coming year. Motor, yes, remains a concern because we know that it's a market studied with a lot of players, and even the OEs are sort of in the process of having their strategy. One of the large players have decided to do it in-house. So This is a business where we honestly seem to be having a hard time, but we are still working on it. Hopefully something good will come out.
Right. Great. And just lastly, when I look at this slide where you're mentioning the project updates, we're seeing that we are talking about close to 3,000 crores of capex just on these projects. On top of this, we'll have obviously some land acquisitions, maintenance capex, etc. So maybe next couple of years, the capex run rate, seems to be like it's going to further be aggressively going up. Could you give some sense on what gives us this confidence? Are we seeing far more visibility of orders? Some sense that would help.
So Mukesh, you know that we normally don't commit for a project unless we have an order in hand. And the real example now is that once we got this order of PXL in hand, then only we committed into the project. So all the projects which currently we have announced, it is fair to assume we have a business in hand.
Right.
So if that's not a concern, yes, normally there is always a challenge that you enter into a business with an anchor customer and then gradually ramp up. But there also you would have seen multiple examples in last few years, like alloy wheels for four-wheeler, alloy wheels for two-wheeler, etc. We have entered into a single customer and now we are serving almost all the key players. So it is the head start what you need, and the head start once you get, definitely you would like to capitalize on that. So that's not a concern. In terms of your second question of whether the capex run rate can further go, but very difficult to say at this point in time. So if you would have seen even FY25 at the beginning of the year, whatever guidance we gave, we have been able to meet that guidance in terms of capex despite some of the new projects being announced during the year, right? So, and as you move forward, the capex number year on year, you see, is broadly in line, but I'm sure we will deliver better growth or growth year on year with better margins in terms of absolute profitability. So hopefully we should be able to fund all these capex needs.
Got it. That's good to hear, sir. Thank you and all the best.
Thanks, Mukesh.
The next question comes from the line of Aditya Jawar from Investec India. Please go ahead.
Yeah, thank you and congrats on good set of numbers. My first question, continuing with Mukesh's question on capex. So capex intensity seems to have gone up quite a bit, and looking at the breakup that you just gave, it clearly seems that this year the capex will be a tad higher as compared to last year. It is very good that we are seeing that growth visibility. But, now there are two things here. Number one, how do we look at our FCF generation capability? Number second, till when we are, we would continue to invest in land. So that would be the first question. Should I go ahead with the others?
Yeah, please.
Yeah. Now, related to that, we are also seeing, there's a moderate increase in debt, while overall debt to equity is still in manageable levels. How do we think about, repaying some of our, debt? The third question is on the PLI. So, how many products we have received approval on, and what, in your assessment, what could be the contribution of PLI in our overall top line? So these are, and finally, question on overall growth outlook. If you can give some sense that how are you seeing the growth by different sub-segments? So what is the growth that you think could pan out in the two-wheeler category, in four-wheeler category, and you can call out, specifically PV and, CV. It would be good. That's it from my side.
Yeah. Thanks, Aditya. Thanks for the compliments. Your first point is capex have gone up quite a bit higher versus last year. Yes, you are right, but broadly in line. So last year we did capex of roughly around 1,300 crores. This is what we are guiding for this year also. And last year we did land investment of roughly 400 crores, and this year it will be maybe something around 200 to 250 crores. And you said how long this will we continue to invest. Hopefully after this we should not be seeing any significant investment. It will be all based on in case there is any new requirement in the areas which there is a new business growth or something where we don't have land. Otherwise, like if you see today also when we have announced this project for the lighting two-wheeler expansion, fortunately we have a land in hand, so it is going into existing land. Another example is this trade land which was bought last year before. The EV for PV business is coming on that land. So it is not that we don't have visibility of what do we do with that land, but we're actually being able to put this land immediately to use once we have been able to get control of this. Otherwise, in past we have faced delay of almost up to 2 years after the board approval to commence the work on the land or to get the land in control. So definitely it's a very big positive from the readiness perspective, because many times customers also look at, in case they give business to anyone, what is his ability to meet their timelines. And once you have land in hand, definitely it's a big plus from our perspective. Then you mentioned in terms of free cash flow. So as you rightly mentioned, this year there is an increase in debt, even though there is the debt equity remains comfortable. But as we move to next year, based on our current workings, our current internal estimates, hopefully we should be able to fund all the capex and land requirement through the internal accruals, and we should not see any significant increase in debt as we move to the next fiscal year. In terms of how do we think of repayment, definitely initially the repayment might be through refinancing of these debts, and as we move forward, this point hopefully will come where our free cash generation is going to be higher than debt, hopefully maybe within FY25 itself. That's our internal target. But if we get more opportunities for growth, then definitely we would not like to leave those opportunities. So it might be a catch-22 situation. But as of now, based on whatever we know today, hopefully we should be cash positive in this year itself. In terms of PLI, when I say cash positive, that's also after the capex repayment. In terms of PLI, number of products approved, we have got approval for 3 or 4 products which are primarily sensors, different types of sensors. And contribution top line, definitely it's not significant. It is very small, so not like to speak about it at this point in time. But there are a lot of products which are currently in the workings, which will qualify, because to qualify you have to first manufacture and meet that 50% DVA commitment. Then only based on actuals you can apply to the government and the regulatory authorities, be it ICAT or ARI for certification. So that's where I think we are, and hopefully next fiscal year we should have 1 or 2 products more which will hopefully qualify in the PLI scheme. In terms of overall growth outlook in different segments, we don't want to guess the numbers, Aditya, but we all know that while our guidance has been to grow at least 1.5x of the industry growth, we have been doing much more than that. And we do have our budgets made, which is primarily on a low single digit growth for PV segment, single digit growth for a two-wheeler segment. And with that, hopefully we should be able to deliver at least 1.5 times to 2x growth in the coming years.
Okay. Thank you and all the best.
Thanks, Aditya.
Thank you. The next question comes from the line of Chandramouli Muthiah from Goldman Sachs. Please go ahead.
Hi, thank you for taking my follow-ups. So first follow-up is just related to, I think, comment that you made to an earlier participant. There is potential for margin expansion YOY. So I just want to understand, is this likely to be more second half weighted when industry might start to see more visible volume pickups, or do you expect this kind of margin attempt to be sort of evenly spread across the year?
No, so the margin what we have been guiding is a blended margin across all. So, we have a lot of these projects which are currently either in the construction phase or in the commissioning phase, or they are maybe in the first year of operation. And all these projects do have the startup costs. So if you see our margin even for last year was on a full year basis was around 9.2, 9.3%. These are also around 9.2, 9%. And next year we are also guiding same 11% plus minus 50 basis points. This is despite the fact that all these projects, like we just spoke about, somebody said about 300 crore of capex and 12 projects undergoing. Some of these projects will come into operation next year. Some projects have come in operation this year. So all those incremental costs have been baked into when we gave this guidance. If you exclude that, actually you would have seen the benefit of operating leverage in terms of margin expansion. But because of so many projects coming on board, it does have the startup cost, initial cost, people cost, admin cost, whereas you don't see any profitability in first year or two. So that all these costs are factored in the margin guidance already.
Got it. That's helpful. And just a couple of follow-ups. So on FRIWO, I think from the quarterly disclosures it's given, it looks like it's about 382 crores in annual revenue. Just trying to understand what the EBITDA and PAT would be there as we look to consolidate that into our financials. And just a couple of data follow-ups. If you could share the alloy wheel revenues for two-wheelers for the quarter once again, and also the electric two-wheeler business revenue that you might have done this quarter.
Okay. So, Chandru, I might disappoint you in terms of margin for a business wise. We don't do business-wise margins. We stopped almost like 5 years back based on the feedback that is being counterproductive for us. So that I'm sorry we're not able to do. But from other customers, AV two-wheeler revenue for the quarter, our AV, the quarter revenue was full year was 932 crores and quarter was 250 crores roughly. And for EV two-wheeler, which is the JV, which has done 382 crores for the full year, the last quarter it has done revenues of roughly 95 crores.
Got it. But I think you were doing a run rate with sales to e-two-wheeler companies of roughly between 160 to 240 crores. So just want to understand that like number if you're able to provide for 4K.
Yeah, so if you remember last quarter we said that this is something which we started doing only because a lot of people have questions around that. So that's we have stopped. But broadly the numbers is in that range only, despite the volume drop.
Makes sense. Thank you very much, and all the best.
Thanks, Chandru.
The next question comes from the line of Abhishek Jain from Alpha Accurate Advisors. Please go ahead.
Thanks for the opportunity. Sir, my first question on the seating business. We have seen a revival on the seating business after many quarters. So just wanted to understand what the key reasons, how much growth.
I'm sorry to interrupt, Abhishek. You're not audible. Could you please come to an area where the network is better? Thank you.
Are you able to hear me?
Yes.
So my question on the seating business, we have seen a revival on the seating business after many quarters. Just wanted to understand what is the reason and what would be the growth for seating business ahead.
So Abhishek, seating business, as I said initially in my brief, the growth has been driven by primarily the new customer addition and start of supply of pneumatic suspended seats and also the bus passenger seats in the domestic market. And a lot of these businesses which we have been able to drive growth, we do expect all these levers to continue the momentum in the next fiscal year and forward as well.
Okay. And in acoustic business, we have seen a degrowth in last many quarters. Just wanted to understand what would be the key triggers for the growth going ahead in this business.
So as I said in my brief, Abhishek, if you would have noticed, the India business continued to do stable in terms of the growth, which is mirroring the industry growth because we are almost 60-65% market share. But because of our operations in Spain, which is in the Platinum Hall, that's where we have seen the drop. In fact, the last quarter itself, the year-on-year drop is almost, I think, 26 crores or something because of significant lower volumes. It is not loss of share of business, but vehicle volume itself are significantly lower, which is what has been pulling down. And this is what we have been sharing for last, I think, 4 quarters of the challenges or the headwinds being faced in the European business.
And my last question on the content per vehicle on the e-Vitara. So how much is the current content per vehicle in Vitara and how much increase is expected once the e-Axle will start to be released?
Sorry, Abhishek, I'm sorry to disappoint you. We don't give vehicle-wise figures.
Just wanted to understand how much difference in the content per vehicle on the EVs versus passenger vehicle right now.
Abhishek, it's the same thing.
Sorry, sir?
It's same.
It's the same. Okay.
Yeah.
Thank you.
Thank you.
Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Sunil Bora to give his closing remarks.
I would like to thank everyone for joining the call. I hope we have been able to respond to most of your queries adequately. For any further information, we request you to please do get in touch with us directly. Thank you.
Thank you, sir. Ladies and gentlemen, on behalf of Uno Minda Industries, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.